You just received a massive tax bill from the IRS for money you never actually touched. Welcome back to your Weekend Wealth Review. I'm your financial consultant, bringing you clarity for your capital. Let's pick right up from our discussion last week on Treasury bills and safe liquidity. Today we are looking at corporate compensation. Specifically, the terrifying trap of unexercised stock options. Most tech employees and startup executives treat stock options like lottery tickets. They sit on them. They wait for the IPO. And they assume they only pay taxes when they finally sell. That assumption is dangerous. It destroys wealth faster than bad credit card debt. Let us walk through the mechanics of incentive stock options, or ISOs, and why the tax code penalizes success. When you exercise an ISO, the difference between what you paid and what the stock is worth on that day is called the spread. That spread is not cash in your bank account. It is paper wealth. Yet, under the eyes of the government, that paper spread counts as income. This is what we call phantom income. You own shares you cannot sell yet because of lockup periods, but the IRS wants its cut right now. Enter the alternative minimum tax. Originally designed to make sure wealthy taxpayers could not use deductions to pay zero tax, it now acts as a trap for middle-class engineers and executives. In 2024, the alternative minimum tax exemption phases out at $626,350 for single filers. Cross that tipping point with your option exercise, and your tax bracket explodes. Let me take you back a couple of decades. Back in 1999 and 2000, thousands of .com employees exercised their ISOs and held the stock. The stock market subsequently collapsed. The value of their shares plummeted to pennies. But guess what did not disappear? The tax bill based on the peak paper value. Good people, hardworking professionals, were forced into personal bankruptcy. They owed the IRS hundreds of thousands of dollars on stock that was now completely worthless. Let that sink in. How do we prevent this catastrophe in your own portfolio? You need a proactive strategy. You cannot just hope for the best when dealing with the federal tax code. This brings us to restricted stock units and the powerful, time-sensitive 83B election. If your compensation includes restricted stock, listen closely to this next part. The 83B election must be filed with the IRS within 30 days of receiving your restricted stock. No exceptions. Miss that 30-day window, and you lose the benefit forever. By filing this election, you choose to pay ordinary income tax on the value of the stock right when it is granted, when the value is essentially zero or very low. Any future growth on that stock is then taxed at lower capital gains rates instead of ordinary income. You permanently shield your startup gains from excessive taxation. It is a simple checkbox on a piece of paper that can save you six figures in taxes down the road. Yet thousands of employees miss it every single year because nobody warned them. We map out these exact compensation structures in our private client sessions. Your employer offers you incentives to align your interests with theirs, but you have to protect your own balance sheet first. Take a look at your employee portal this weekend. Review every stock option, every restricted unit grant, and every vesting schedule you currently hold. Ask yourself what hidden tax time bomb is ticking inside your employee compensation package right now. Stay disciplined, protect your downside, and I'll see you next Saturday.